First chart that I'll pull out is a chart that defines a bull market currently, which is a narrow bull market. Now, let me explain this. You'll see two numbers here. This is 41 and 50. Here you see 50 DMA. So this is 41% of stocks in the market are above 50 DMA, 44% of stocks are above 200 DMA, and 47% stocks in our market in Nifty 500 index are above 200 DMA. Now, these three numbers that you see, now 50% out of the 40% stocks that are above 50 DMA are extended, which means let's say there are total 100 stocks in the market, 40 of those are above 50 DMA, and 20 of those, that is 50% of 40, are way above 50 DMA. Similarly, there are 40% of 44% stocks that are way above 200 DMA. And same applies here, which is roughly about 40%. This tells you that the market is really narrow in nature. Narrow means there are some stocks that are closer to 50 DMA, but those are not tradable because they have poor relative strength, they belong to poor sectors. And those stocks that are above 50 DMA, out of those about 50% are so extended from it, let's say 8, 12, 15% above 50 DMA, that as it is, there is no risk reward there. So this is the current snapshot of our market. We have fewer tradable opportunities because only about 50% stocks are above 200 DMA, which defines a long-term trend. And even within that, about 30-40% stocks are way above 50 DMA and 200 DMA. This is why the overall breadth is narrow. And on top of that, the tradable opportunities within stocks that are conducive, that is also limited. Now, what usually happens in a narrow bull market? See, in a strong bull market, this number that you see 200 DMA, almost 70 to 80% stocks remain above 200 DMA. And then they keep fluctuating, so you get a lot of investment and trading opportunities. But in a narrow bull market, typically this is what happens. This is a snapshot of 2017 to December 2020. And a narrow bull market is highly prone to sudden reversals. So whenever you have a clean breakout, you will see reversals. Again, when you have a breakout, you will start seeing reversals. But from point A to point B, market would be trending higher. It is just that it is highly volatile in between, mainly because of narrow breadth. When breadth is a bit wider, the sectors that take the market higher here, when they start retracing in this leg, then those sectors that are strong and did not get allocation here, they start getting allocation in this leg. And then again, market continues to go up. But in a weaker market, what happens is when the price goes up and the stronger pockets go up, the weaker pockets don't move that much. But because they are weak, in a pullback in stronger pockets, the weaker ones don't get major allocation. And that is why you see such sharp reversals coming in the market. If you look at the recent Nifty 500 chart of this year, 2025, you will find plenty of such reversals that have played out. It's mainly because about 50% sectors in the market are strong, whereas the remaining sectors are just not doing well. So when you divide the market into large cap, mid cap, micro cap, and small cap, you would find that the market is still in this pocket. That is, large to mid large cap stocks are doing well. And even some mid cap stocks are doing well. If you look at the mid cap select index, last week it staged a breakout because a narrow pocket within mid cap is doing well. But micro cap and small caps, they continue to struggle in this market. Which sectors are currently leading the market? It is banks, finance, defense, hospitals, chemical and fertilizers, hotels, capital market, insurance, broking, auto, consumption, and metal. And there is a large pocket of the market, let's say IT, FMCG, some pockets of pharma, some pockets of consumption. They're just not doing well. Some digital names also not doing well. So this is how the market is split. And this is one of the reasons why such charts will be more common. Now, as we enter 2026, there are some other challenges also that exist within the bull market. And those challenges are mostly global in nature. Now, this particular chart I think I've taken from Bloomberg. This shows the percentage of US market in terms of market cap with respect to the global market capitalization. In the year 2001 to 2003, this number had reached about 56-57%. Then you started seeing money flowing out of the US and into the emerging market. That is when you had this fantastic 2003-2007 kind of a bull market. If you see post 2010, the emerging market allocation has largely been flat. In fact, if you take the peak at 2008, it has been down about 3%. Even Japan has seen relative outflows, but majority of money has gone into the US. This is problematic. This is problematic because if you look at the US market post-COVID, this was the COVID pandemic. This chart I've taken from econoviz.net just for the source purpose. And if you look at the chart here, we've had a vertical explosion. The problem here is that this explosion is not led by all US sectors. It is led by a handful of sectors, primarily AI, semiconductors, and those kind of sectors. But if you look at advanced economies, leaving US aside, they are not that far away from 2008 top. If you look at the emerging market index also, it has headed up. But the divergence between US and rest of the world is just too much at this particular stage. If you come down to the historical chart of S&P 500, between 1999 and 2002, when US started seeing outflow, S&P 500 started struggling. This, I think, is a weekly 200-week moving average, or I may be missing it, but hope you get the point. There's been a gradual decline. Sometimes the decline have been sharp as well, and due to that, majority of world markets struggle. Then the bottom was made in 2002, and emerging markets started attracting a lot of flows, and then the bull market resumed. Now, in this particular case, whenever US has a gradual decline means over a period of 24 to 36 months, let's say the US market falls about 20 odd percent, that will typically get digested by emerging market and rest of the world also, and respective markets will start doing well. But if we have such kind of a fall where a 50% erosion happened in S&P 500, more so in Nasdaq, or a 2007 2008 kind of a decline where typically in such phases money gets realigned, in this particular case post 2010 money started moving in the US, then it would be very difficult for emerging markets also, and more so for India. I'll come to that in a bit. So as of now, what is happening? We are seeing a scenario where majority of stocks in the US market are not doing that well in terms of contributing to the earnings growth of S&P 500. There are only top 10-12% stocks that are driving that. I'll just come to that slide in a bit. The next chart is about our own macro. I won't spend a lot of time here because when it comes to our own macro, when it comes to liquidity, GDP, inflation, everything is in line. Everything is in favor of stock markets. And GDP is also set to improve. Our earnings is set to improve. It is just that the sentiment is not great. Sentiment is not great because of obvious reasons also. The world is chasing different kind of stories these days, and India does not have those things to offer. I'll explain that in a bit. This chart now reflects whether Indian macros are peaking at the wrong time. Now, what do I mean by this? There are three segments. This is for India, that is valuation, business friendly, and the IPO primary market. This is for the US market valuation, the sustainability of what is going on in the US, and the MAC 10 companies. If you come to the valuation part for India, valuations, yes, have cooled off a bit, but mostly in the large to mid cap space. I think in the mid space, a lot of pockets are still inflated. They need more time correction. And if you look at the small cap index or a micro cap index, you will see they're not moving as swiftly or even smoothly, like something like Nifty 50, Nifty 100, Nifty 200. Now, business friendly. Currently, our macros are business and market friendly. But in case we start seeing a sharp cut in the US market because of certain things that I'll explain that are going on in the US market, then our market won't be able to survive that. We will fall with the US market. It is inevitable. And the third more concerning thing that is currently going on is the IPO frenzy in the primary market. And I sincerely hope our market regulator is looking into this because some of the fund managers need to be more accountable with their allocation. I won't speak a lot on this, but I hope you get the message. There is a lot of IPO frenzy currently going on, irrational exuberance, I would tell you. It can continue for a long period of time because markets are typically like that. But it's very clear that most of the IPOs that are coming are not in favor of new investors, that is retail traders and investors. That is my limited understanding. So these 3 points are definitely something that will bother the market in the next 6 to 12 months also. The more important part is here, which is US valuation. Now, 90% of S&P 500 companies contribute only 10% of earnings growth currently in S&P 500. Majority of earnings are coming from top 10% companies, which is the MAC 10 companies. Now, what is the MAC 10 company? It is the companies like Nvidia, Amazon, Google, Netflix. I hope you get the point. Now, some of these companies, that is technology and growth oriented companies, have market cap greater than many countries. Now, for instance, if you look at the market cap of Nvidia against whole Indian market cap, you'll find that Nvidia is larger than Indian market cap. Now, this brings the sustainability issue point. See, I don't think there is a bubble yet in the US in terms of AI, but there is a lot of one-sided allocation that is happening. So S&P 500, if you look at the chart of S&P 500 here, this is purely being driven by a handful of companies. Now, let's say in 2026 or in December or late part of November, you start seeing sharp fall in Nvidia or something like a Palantir or something like even Google, Alphabet that is, or Meta or Tesla. You start seeing massive fall in those stocks. You know what is going to happen? The 90% of the market that contributes only 10% of earnings growth, that is going to go down at double pace. The reason being, these 10% companies are still coming out with stellar earnings. Yes, a lot of money is being rotated within the AI circle. That in itself is a topic that would require a separate video. But the 90% of companies that are there in S&P 500 have very poor earnings growth. Can't even match the median earnings growth that is happening in India. It is only the 10% companies in the US that is driving the S&P 500, that is driving the sentiment, that is pulling all the capital from around the world from sectors that are not performing well. So this is a problem, not in terms of a bubble. There is no one I have seen who can time a bubble well. Yes, you hear a lot of things about Michael Burry currently shorting a lot of AI stocks, $1 billion worth. But remember in 2007-8, when he was right, he started shorting in 2006. He waited for, I think, 12, 14, 16 months before things started working in his way. So I rely on wisdom of Peter Lynch in this, that there is no living entity till date who has timed a bubble or a market top. So don't make that mistake. Go with the flow wherever the market is taking you, but be nimble footed. That is something I'll speak about. But I hope you understand why this is a problem. This is a problem because too much of concentration is happening in one place. The next chart I'll show you is the FPI FDI cycle. With respect to India, it is not going to change so soon. I won't talk much about FDI because FDI is a different kind of a money that comes in. For example, RBL Bank got some money or Federal Bank got some money. That is a different kind of a money, different type of a money. It's a real long-term kind of a money. I'll mostly focus on FPI. All right. So when you look at the fund allocation that happens in India, let's say the world gets $100, about $25 go to the US, 25 to 30, I think. About 18 to 24 goes to China. About 9% goes to countries like Singapore. Just 2%. Out of $100, we get roughly 2 to 3, or maybe it may be $4. Whatever investment amount is given, let's say a global fund manager is given $100 to invest in the world, India will get $4. Others, 45%. Now here, other does not mean only countries. It includes assets like gold and silver and cryptos also. The reason why I have put out this slide is because India as a country needs to ask itself, what unique do we offer to the world? I hope you understand. USA offers, latest technology. USA offers a lot of things, R&D, research development, whether it is in pharma, whether it is in semiconductors, whether it is in defense. China, the same deal. That is why these two countries get the maximum allocation in terms of investment. Singapore is, of course, a global hub. And other countries, you look at gold, silver, done very well. Look at cryptos, what kind of a massive return cryptos are given. Given that, why would India get massive allocation from FIIs? This is what you need to answer. And once you start asking this question, you would realize that India still has a long way to go before we start getting massive FII, FPI money inflow. Yes, periodically it will come, but I'm talking about sustainable flows that helps the index compound at, let's say, 20% CAGR or 25-30% CAGR. That kind of a growth we are not going to see. If I have to define the kind of bull market that we are into, we are in a slow bull market, but the pace exists in terms of movement in only select pockets. In the first 4 months of this year, it was mainly in defense, in capital market. Then it shifted to banks and finance. Then it shifted to autos and consumption. And now again, a combination of banks, finance, defense, auto and consumption is taking the market higher. So you have to be strategic in terms of identifying where the money is flowing. It is not going to flow across the market, across sectors. That time is long gone for India. And I don't think it is going to come back so soon. In between, whenever we will have strong rallies in India, it will be only in those sectors, those themes that are currently doing well. So if you look today, what is doing well? It is banks, finance, metals, defense, hospitals, some new age businesses, autos, and some select consumption names. These are the only pockets that are doing well. So when you see some FII, FPI inflow coming in, these are the pockets where you will see movement. Whereas there are whole set of sectors that are not getting allocation and they won't get until and unless their structures are right and long-term stories again return. So now coming to the part that given the information that we have, how should we move forward? Because information is of no use if you can't apply it in real time and benefit out of it. The first thing I would tell you is that you will have to define a logical framework for the year 2026. I had the opinion that 2025 was going to be incredibly challenging for the market. It has largely turned out to be that way. But as we are getting closer to 2026 and I'm seeing a lot of global data points play out, I think 2026, unfortunately, is still going to be challenging for us. In between, we will have sustainable trends, but you will have to be nimble footed in those trends. I will just explain this point in a bit. The first point that I'll cover is that about global market. Heading into 2026, you will always have to ask every week whether the global market rally is broad based or it is narrow based, which means are most of the stocks participating or only some stocks are participating. How do you check that? Check the Russell 2000 index and the Russell 3000 index and then compare it with something like a Nasdaq or S&P 500. If you find all these indices are moving together, then the global markets are healthy. But if you find that the global market starts trading on back of only few pockets in the market, whereas Russell 2000 or 3000 starts diverging from S&P 500, be careful. By being careful, I would tell you that remember that there is no market that will be able to tolerate a shock from the US. If the US market starts cracking 10, 15, 20%, there is no market in the world, including gold and silver or any asset that you know will be spared. All these decoupling theories that you hear on television are baseless. Don't rely on that. The next is define your universe. You have to embrace the fact that you can't chase everything, you can't catch everything. You have to ask, what do you understand well? And then you have to be with it. I've always maintained, what do I understand well? I understand banks and finance very well. Then I understand metals and defense also. Hospitals, off late, I've started learning a lot about the hospital sector. So I understand that also very well. And yes, some new age businesses. So this becomes my universe. It does not mean that I don't look at other stocks or sectors. It just means that I study and research these pockets very well. You have to ask, which pockets do you understand? Again, I'm borrowing from the wisdom of Peter Lynch: own what you know well. This is a timeless lesson that he has taught. The third point I would tell you is that you will have to be nimble footed. I'll read out this particular paragraph because I don't want to miss out on anything. You cannot blindly hold stocks in this market. Hold till the bull market in your selected pocket lasts. You have to use 50 DMA, 50 DMA pivot, and 200 DMA to manage positions. Let's say you capture some fantastic stock in a market. Let's say you capture this kind of a swing in the market. You go behind the right kind of a pocket, you identify some stock, and you capture the trend. You have to trade the William O'Neill way. That is, if you're not someone who is of that kind of a mentality who buys a stock and forgets, then that is not for you, or who does not touch the winners, then this is not for you. But if you capture a lot of things and you then give back a lot of profits and you get frustrated, then you will have to follow what William O'Neill has taught. You catch a swing. This is a trailing 50 DMA. When the stock breaks 50 DMA, or let's say you have a rally of 30, 40, 50%, William O'Neill always says, take out 25 to 30% position, trail the remaining with 50 DMA. If it breaks 50 DMA, exit another 33, 40% position. And then, it comes below 50 DMA and rallies. So this becomes the 50 DMA pivot. If this again is taken out, exit completely. Again, here, stock rallies 25, 30, 40%, pull out 33% positions, book profits. The day it breaches 50 DMA, book another 20, 30% position. In this case, the 50 DMA would be the low of this candle, which was taken out with this candle here, exit completely. And then again, you will get an opportunity where a stock is setting up. This is a fresh stage 2 structure. RS is also trying to move up. It's trying to break out. I hope you understand. So you will have to be nimble footed with your positions for the next 12 to 18 months. This does not mean buy today, sell tomorrow. This does not mean swing trading. It means hold the position till the structures last. The last point is selection of groups. That is sectors. In every cycle, you will see there are specific pockets that perform. As I explained in the earlier part of the video, first 3 months, something else was performing. Another 3 months, something else came up. All right. The easiest way to check this is check the sector against Nifty 500, a sector that is rising, a sector that you have to pay attention to. You will have to evaluate this every week, or let's say every 15 days. You cannot just buy something and sit today because of the kind of things that are currently happening. A lot of realignment is also happening in the world. Of course, when we enter 2026, I will make a dedicated 2026 outlook video, just as I did for the year 2025, where I'll have more clarity today. It is just, I think, second week of November. So there is still some time to go. In between, I think for our markets, the trigger point is the India-US trade deal. Whoever comes on the television or X or any platform and tells you that the US trade deal is not that important, I would tell you, don't listen to that. The US India trade deal is absolutely pivotal from sentiment point of view. The day that deal happens, you will see the kind of rally that happens in the market. Immediate sentiment impact will be there, but that is a big deal. It's a big kind of a hanging sword on our market. If that were to go, then sentiment wise, we will find it more easy, at least on the indices, Nifty 50, Bank Nifty, Nifty Finance, all these indices will start moving up. And once these indices start moving up, then, sentiment changes in the micro cap and small cap space also. So we are in a tricky environment. I'm not telling you that this market is going to crash or this is not a bull market. We are in a super duper kind of a bull market, but a very selective kind of a bull market. And I'll again take you back to this chart. In a narrow and selective kind of a bull market, frequent pullback keeps happening. And that is why it is very difficult to hold on to positions. So that is the crux of it. And you cannot escape this because every day you are seeing a lot of world markets go higher, but India does not perform that well. It is mainly because, number one, yes, we are super selective in terms of what is moving. You can also say this is a bottom up kind of a market where individual stocks are doing really, really well. And some sectors are also doing well. But indices on the whole are still struggling. So this is what it is. You have to be ready for anything that comes from global market. Had we been trading in an isolation kind of a scenario, I would tell you India is 100% heading up because our macros are so perfect. But as I start looking at the global market data, I get a feeling that it is much better to be nimble footed and to not be a blind bull in this market. So the global market data is forcing me to be more alert. While I remain super bullish on Indian market and more so on certain pockets within Indian markets that are structured beautifully, including the technical part, the fundamental part, earning pickup is going to happen in the next quarter or maybe after that. Those things are perfectly aligning. It is just that there are some things globally that are bothering me, and you will have to keep an eye on that. Define your universe, be nimble, and be selective when it comes to where you want to allocate your money. All right. So I'll come up with one more video when it is required. Thank you so much for watching. Have a great weekend ahead. Take care and be safe.